Welcome to Corporate Finance. In problem 4.1, we're given that Wesney Corporation intends to grow sales costs and all balance sheet items by 15% from year one actual to next year's forecast. And this is what you would be doing when you're doing budgeting or financial planning or strategic planning. You're forecasting into the future. So that's what we're working on here in Chapter 4. The equations are sales minus cost equals net income, and assets equal liabilities plus owner's equity. These are your basic income statement and balance sheet equations. So year one actuals are given to you, and your job is to figure out the forecast values. So to get the sales number for year two, we simply take year one actual 39,400 times 1.15. So equal D10 star 1.15. To get the cost number, similar thing, equal D11 times 1.15. And then to get the net income, I can just take sales minus cost, or I should be able to take equal D12, if you want to check it, equal D12 star 1.15. And I get 5405 for my net income. We would expect, unless otherwise told, all of that will go into the retained earnings account on the balance sheet, unless there's some decision to pay a dividend. And we're not giving any dividend information, so we're just going to assume it's going to all 5405 going into the equity account on the balance sheet. To get our asset number for year two, we simply do the same thing. We take equal H10, which is your asset number of 29,200 times 1.15, get 33,580. Similar for debt, 9,400 times 1.15 is 10,810, and the equity account, 19,800 times 1.15 is 22,770. Add them up, total debt plus equity, and I get 33,580. So you see my assets equal my liabilities plus owner's equity, or debt plus equity, and the balance sheet is balanced. Now, the author wants to know, what is the plug? Was there a plug done? Did something else happen here? So what we would expect to see is we expected 5405 to go into the equity account on top of the 19,800. We see by subtracting the two equity numbers, it only went up 2970. If I take I13 right here minus H13, I get 2970. So what happened? I expected my retained earnings in the equity account to go up 5405 and only went up 2970. So what is the plug? The plug is the difference between those two, equal J13 minus J15. And I see that the plug is a negative 2435. And what that means is the officers of the company decided to pay out a dividend out of that 5405, and so they had plugged in a dividend plug of 2435 going out to the shareholders. In number two, Wesney Corp same company pays half of their net income in dividends, and now we have a dividend assumption, and half net income in dividends are 270250. How did I get that? I took my 5405 and divided it by 2. So 5405 of net income divided by 2 is 270250. Roughly 2703 I'm keeping, and 2703 I'm giving away in the form of dividends. So again, in the balance sheet, you see my assets are the same as they were in problem 1, 33,580. The debt stays the same, 9,400. The equity stays the same. So because the assumption is, now we have a slightly different assumption here, too, cost and assets will vary with sales. So the sales went up 15%, but debt and equity do not. The owners of the company have said no more debt, no more equity, and then half of my net income will stay with the company into additions to retained earnings. And then do we need any other plug? So what is the plug or external finances needed? So we simply add up 90, so 33,580 on the left side, on the asset side, and on the right side we have debt of 9,400, no change. We have equity of 19,800, no change, and then we add in the half of the net income into the retained earnings account 2703, and I get 31,903. So I have 33,580 on the asset side of the balance sheet, and 31,903 on the right side, debt plus equity, liabilities plus equity. And so the plug I need to balance this balance sheet, what do? I plug it in to balance the balance sheet. The plug is the external financing needed, and that is 1678. I get that by taking I-28, which is the asset number, 33,580 right here, minus I-33, which is my liabilities plus equity. To balance that balance sheet, I need to plug in $1,678. There are your answers to problem number 2. In problem number 6, we have Mandy Company. Assets and costs are proportional to sales. Debt and equity are not. 30% dividend payout ratio. That means I'm giving out 30% of my net income. Therefore, my retention ratio is 70%, or B. So B is 0.7. What is the internal growth rate? What is the rate at which I can grow my company without any plug whatsoever? No plug, and we see the equation for that is ROA times B. Internal growth rate is ROA times B, divided by 1 minus ROA times B. So let's look at the ROA. How do I do ROA? How do I do RO anything? Return on anything is net income over anything. So return on assets is net income over assets. So ROA would be net income in cell D49 divided by total assets in cell H47. And then B would be, I separated B, and that is in cell D51. And I just take that ROA that I just calculated, which is net income divided by total assets, times 0.7, which is my retention ratio. Why is retention ratio 0.7? Because I said in my net income pie I would pay out 30% and keep 70%. So that's where I got that retention ratio of 0.7. And so I'm going to take that ROA times B divided by 1 minus ROA times B. So 1 minus the numerator goes in the denominator. And I get an answer of, if I do that math, ROA times B divided by 1 minus ROA times B, 8.8143%. What does that mean? Now, you passed the test, you got an A, that's great. What does IGR of 8.81 mean? It means that I can grow my company at 8.8143% from year 1 to year 2 without any plug whatsoever. Okay, so I would take my sales, year 1 sales number times 1.088143, cost times 1.088143, and so on, all the way down the income statement. I would take my assets times 1.088143. I would do nothing to my debt and nothing to my equity, and when it's all said and done, my balance sheet should be all balanced out. No plug necessary. There's our answer to problem number 6. In problem number 8, Tran Company, assets and costs are proportional to sales, debt and equity are not, 40% dividend payout ratio, which means a 60% retention ratio, and a constant debt to equity ratio. What's the maximum increase in sales? No new equity is issued, debt is okay. So what we're looking for here is the SGR, or sustainable growth rate. That's the rate at which I can grow my company year over year, with taking on only debt financing as a plug, no equity financing, too expensive, difficult to get, while maintaining my debt to equity ratio. So there's some conditions on that, how fast I can grow my company year over year, taking only debt as external financing needed, or the plug, no equity, while maintaining my debt to equity ratio. So how do I get and always use year 1. So when I'm calculating the IGR in problem number 6 and the SGR in problem number 8, always use year 1 numbers to calculate, because you're trying to find that magical rate at which you can grow under all those conditions. So SGR is just ROE times B. What is ROE? What is RO anything? Again, you should know this, net income over anything. So return on equity would be net income over equity, very simply. That would be net income D69 over equity of H70. There's your equity number in H70. I'm going to multiply that by D71, which is your B. That's your retention ratio. So ROE times B divided by 1 minus that numerator and then divide those two numbers. And I get a sustainable growth rate by taking E73 divided by E74, I get a sustainable growth rate of 5.8654%. Now again, what does that mean? You got an A on the test, you got the answer correct. What does that mean? It means I can grow my company 5.8654% year over year, increase my sales, my cost, and my net income. I would keep 60% of that net income number. I would multiply my assets times 1.058654. Same with debt and equity. And I should get a debt plug, only debt. We can only take on a debt, external financing needed to plug in of 5.8654% to balance out that balance sheet. So that will be the amount of the debt plug. The debt and debt to equity ratio must be the same in year 2 as it was in year 1. Okay, it's got to be the same. The maximum increase in sales that I could get under this sustainable growth rate would be equal D65 times D73. So 5.8654% of 38,600 is 2264.04. So that would be your maximum increase in sales dollars that you could get with this sustainable growth rate situation. Debt financing only is acceptable, and maintaining a constant debt to equity ratio would have to result of this exercise. And there are your answers to problem number 8. Finally, in problem number 14, we're going to look for the SGR again with some different givens. Kayla's Heavy Equipment Company has the following fundamentals. Profit margin of 7.3%, that's your net return on sales. Capital intensity ratio, 0.95 times, that's 1 over asset turnover ratio. Your debt to equity ratio is 1.05 times. That means your equity multiplier would be 2.05 times, or 1 plus debt to equity. Net income is $84,000, and dividends we're going to pay out is $24,000. That means the retained earnings we're going to keep is $60,000. And to get that retention ratio, which I'll need later, I'm going to take my net income of $84,000 minus the dividends paid, which will be $24,000, so that'll be $60,000 even divided by $84,000. That will be your retention ratio. And I'll take my ROE first. I need to calculate ROE. I have my B now. My ROE will be my net return on sales, or profit margin, 0.073, times ATO, asset turnover, which is 1 over CIR, capital intensity ratio, so 1 over cell D82, and then times 1 plus the debt to equity ratio to get the equity multiplier, 1 plus D83. That gives us a ROE, return on equity percentage, of 15.7526%. And then my B, I had calculated by taking my retained earnings divided by my net income. Got a 71.4286% retention ratio, or B. And then I simply take those two numbers, ROE, which is D90, times D92, which is the retention ratio, divided by 1 minus those same numbers, multiplied together. And I get a SGR of 12.6784%. Now again, what does that mean? That means I can increase my company's sales 12.6784% with only debt financing allowable. While maintaining my debt to equity ratio, I can grow 12.6784% debt financing only. And there are your answers to the problem number 14.